Hello everybody, this coming back for part 2 of the chapter 2 life insurance module. We just left off here at the convertible term life insurance. So here we're discussing how we can convert term life insurance into permanent life insurance. And we talked about potentially the new plan, so the new permanent plan, that new potential whole life plan that you would have potentially would be based off either your attained age, okay, or the original age. Now, depending upon how the contract is written, that's going to be how they're going to base the new premiums of your new permanent insurance contract. And obviously there's, impacts here, as we know already, that life insurance premiums are mostly based on how old you are. So potentially if you do get this original age, okay, type, your new premium under your new permanent insurance plan will most likely be much cheaper than if you have this attained age component. With that said, we know that insurance companies aren't very dumb, they're very smart. If you do have the original age component within your contract, more than likely your term life premiums, so your previous life insurance contract, those premiums would have been higher. Okay, so they're going to recoup the cost in some manner there. So let's go down to the next slide. And this is going to be focused on term life insurance's advantages and disadvantages. So there's lots of different advantages and disadvantages for this simple term life insurance. Some of those advantages, the most important here is the low cost. Okay, so comparable life insurance, term life versus whole life, or comparing to even universal life, term life insurance is much more affordable. And that's one of the main reasons why individuals will look to get term life insurance, because the premiums will be much lower on a monthly or yearly basis, and they can potentially, incorporate that in their, daily living expenses that they have. The premiums are guaranteed over the term. Okay, so whether you have a 10-year term or a 20-year term, whatever you have, those premiums aren't going to change over the term. So there's some, guaranteed in there that those premiums aren't going to change. You can plan accordingly to that. Now, that's not to say that at the end of this term, right? So at the end of the term, the premiums may change and will change. Okay, so, but the premiums are guaranteed for specific terms, whether it's 5, 10, 20 years, whatever it is. We talked about the renewable and convertible features, so this is nice to have. Okay, so you have the opportunities to renew, convert. That's a very good feature to have. It gives you some potential understanding of how you will be covered in the future. You know that you may be able to roll this 10-year term over and over, give you a little bit of assurance that you will have insurance coverage. And here we can customize the term plan a little bit to meet specific potential needs that you have, potential risks that may not last your entire life. Maybe these risks, like I said, maybe it's a debt risk, maybe it's a specific liability that you have over a specific 5, 10, 20-year period of time. You don't necessarily need insurance, right, for your entire life. These will provide you, term life insurance will provide you with some advantages to customize and meet those specific needs that you have in terms of specific time frames. Disadvantages, premiums increase as you get older, right? So again, remember, the premiums are going to be guaranteed over the term, but then at the end of the term, your premiums are going to rise, right? And we looked at the slide in the previous video that documented as you get older, yes, the premiums are going to rise pretty significantly. The coverage not available past the certain age, depending on the insurance company, but most of the time they'll be somewhat hesitant to provide you with term life insurance once you pass around the age of 65. They probably not going to want to insure you all the way, right? In terms of a term, the term of the contract ending past 75 and especially 80, the risk is just too much there. And again, a disadvantage is when we compare this to a whole life or universal life. At the end of the term, this is worth nothing, right? As opposed to a whole life or universal life. insurance, there's usually some sort of cash surrender value or investment value within those policies. Here in term, remember we talked about this is no frills insurance here. There's nothing there. There's no cash surrender value. There's no savings component of that. So those are some of the advantages and disadvantages there. Now, who are some of the typical uses of insurance? You know, again, we talked about cover risks before the age of 60 or 70 when you may not be able to obtain that. Short-term risks, we already talked about that, okay? Decreasing risk, loans, right? You have some liabilities, mortgages, and potentially this one, right? Potentially you have some divorce obligations or marital obligations that came out. You may be liable to pay child support or spousal support for some duration of time. So potentially, you know, a term life insurance product may be imposed on you to ensure that you will meet those demands even if you do pass away. So term life insurance is good for that, as it's obviously cheaper. We talked about that in the advantages. And also it's there for a specific term, right? The divorce obligations or child support obligations may not last forever. They just may last for 5, 10, 20 years, whatever it is. You can customize this here a little bit. We talked about inexpensive, right? So limited cash flow, those types of people will have some of those advantages. And because it's been inexpensive, you can, you know, a common phrase that goes around, you know, you buy term insurance to cover your initial risk and then you invest the difference. Now, this can be discussed in two different fashions. You know, some people buy insurance potentially not only for risk coverage, but also an investment or savings vehicle. Now, depending on the performance of the market or those specific products that you may invest in, whether it's a segregated fund or within the actual whole life policy or within the universal life policy, what's the return there? Some people prefer to get this no frills term life insurance and then take their own cash in with what they save and go invest this in potentially their own individual accounts, whether that's in a registered account like an RSP or TFSA or a cash account, either one of those different ways, and potentially you can get a potentially higher return here within there. Now, depending on whether you have it in a registered account or a non-registered account, there's going to be some tax implications that also correspond with that in the after-tax return. But those are some common uses of term life insurance. So that's the second portion of chapter number 2. I think we've hit most of the main topics there. Again, it'll be good for you to go through, review some of those the materials that we just looked at here in this presentation. And again, if you have any questions, you can always put the questions in the comment boxes below, and I'll be happy to provide you with some feedback. Thanks for watching.